How long are we going to be in this economic downturn?
If you look back at the last 100 years or so, the average bear market, meaning downward stock market, lasted on average of 9 to 13 months.
Okay.
Meaning about a year is the average bear market. But do you know what's interesting is our economy goes through these booms and busts because it's just the way of a credit-based system. You build up, you get huge, and then you need to deflate. You have these booms and busts. And what happens is the bigger the bubble gets, the bigger it has to fall. Do you want to guess when was the longest period that we've ever gone without a recession?
Oh, was it probably mid-90s?
No, it was 2020.
Really?
Before the 2020 pandemic, it was the longest time that we've ever gone without a recession. By December of 2019, it was 126 months of no recession, which is the longest period in American history without a recession. Then we saw a forced recession because the pandemic hit, it shut the economy down. But if you just remove the pandemic, this is the longest time that we've ever gone in the history of America without any sort of economic downturn, without any sort of economic pain, without any sort of correction. Now you might ask yourself, why? Well, we did start to see a little bit of a slowdown in 2018 into 2019, but then the Federal Reserve Bank started cutting interest rates. So back then, President Donald Trump was the president, and we started to see the economy start to slow down. We were talking about that on this YouTube channel. I was talking about how the economy started to slow down. We were seeing slower investments, and this was worrying a lot of people. And so when the economy started to slow down, instead of letting the economy slow down, President Donald Trump then put a lot of pressure on the Federal Reserve Bank to cut interest rates, which is why in 2019, we cut interest rates multiple times. I think it was 3 interest rate cuts in 2019 to make borrowing money cheaper, to help stimulate the economy, even though we were supposedly in the strongest economy of all time. So this helped build up the bubble even bigger. Then 2020 came and shut everything down. But now here we are today at a time where we went through the longest period without a recession ever. 2020 was the worst economic downturn since the Great Depression, yet nobody felt any financial pain. In 2021, when we were in a recession, luxury brands like Louis Vuitton and Gucci were breaking record sales.
Right.
Now just think about that for a second. We're in a recession. We're in the worst economic downturn since the Great Depression. Yet people have more money than ever. They're spending money like crazy. There's a 2-hour line to get into Gucci. There's a 2-hour line to get into Burberry. I was living in Chicago in 2021, the summer of 2021. And downtown Chicago has this street called Michigan Avenue. Beautiful area where all the nice shops are, all the high-end stores, the places where I don't shop, right? But I like walking down there because it's really nice. It's really beautiful.
Right.
So I loved walking down there, me and my wife, and every single day, weekdays, weekends, doesn't matter the time, there was a line wrapped around the street for every high-end store, from Burberry to Gucci to Louis Vuitton. And I'm sitting here at that time, and I was just like, 1, where do people have all this money? 2, where do people have all this time? Because you have people that are waiting 2 hours, sometimes longer, to go and spend $2,000 for a handbag, when at the same time we're supposedly in the worst economy since the Great Depression. And so things just weren't making sense. And now here we are today. We're starting to see the impact of really everything. I mean, you can't desensitize yourself from all pain. I mean, we don't want to feel pain. Nobody wants that. But the reality is economic downturns, market crashes, these corrections, it's a way to refresh the economy. And these are good because it's a way to get the bad investments out. It's a way to get the toxic investments out. It's a way to pull out the bad ideas, the bad things. That way now you can have more sustainable, more actual fundamentally strong companies, strong businesses survive, because at the end of the day, you need businesses that are productive, that are producing real value, that are producing real profits to help grow an economy sustainably. Because if we run an economy that is reliant on free money, aka the Federal Reserve Bank printing money and the government giving out free money to businesses, so just inflating this bubble. So think of like literally a bubble where you have the Fed and the government just pumping money into it. When you rely on that, you start to grow a lot of not so sustainable, not so productive businesses, but there's money flowing. So businesses can get millions of dollars very easily. They can hire a whole bunch of people, but no one's doing anything productive, which doesn't actually help grow the economy. So then when you grow the bubble bigger, eventually you're going to have to let it deflate, because then you start to realize, oh no, there's a cost to the money printing.
Right.
It's causing inflation. It's causing supply chain issues. And so now when you realize that you have to start deflating it, now the air has to come out. And when the air comes out, you have to feel the pain for that. So the average bear market, go back to your question, the average bear market, downward stock market, lasts 9 to 13 months. I read one report is 388 days. Another one said 268 days, something in that range. So between 9 and 13 months is the average downturn. Now, what does that mean? It means that within those 12 months, typically, that you will see the market go down by more than 20%, and it'll probably go lower. And this many times does induce a recession, but then within that year, you start to see then the market start to go up, or around a year, then the market starts to go up. And the people who buy during that year are able to make significantly higher profits than the people who don't, because now if you can come in and find a good company that goes on sale, meaning their investment price goes down because the economy is hurting, well, now you get to see much bigger returns because you were able to come in and buy at a discounted price. And these are the things where now it's just understanding that, okay, one, history doesn't exactly repeat itself, but it does rhyme. So is this downturn going to last 12 to 18 months or 12 to 13 months? I mean, it depends. It depends on, one, how bad the economy gets, and it depends on, second, what the Federal Reserve Bank does. Because we're in a very strange time right now. And the reason why it's strange is because in our current climate, a recession, like when we hear about the word recession, this is good news for the stock market. And the reason why is because a recession means that the Fed might start stimulating more, and that means that the stock market might go up. Let me explain what that means, because there's a lot of substance to that. Typically, when you hear the word recession, that's bad news for the stock market. It's bad news for the economy, because now the economy is going to slow down. If the economy is slowing down, that means companies are making smaller profits. If companies are making smaller profits, that means they have less money to invest in more growth, meaning less employees are getting hired, meaning everything's slowing down, meaning smaller profits, which would then translate to a lower stock price. But nowadays, what's been happening, not just over the last few days, but if you look at over the last 2 months, what has been happening is anytime we hear reports of the economy slowing, that has been good news for the stock market. Now, this is very counterintuitive, because traditionally, typically, bad news for the economy should be bad news for the stock market. However, the economy and the stock market, while they're similar, are not directly, linearly correlated. So what's happening is people in the stock market, investors and traders, are saying, oh, a recession, that's good. Because if we have a recession, that means the Fed is going to have to bail us out of the recession. And if they're going to bail us out of the recession, they're going to have to print money. They're going to have to cut interest rates. They're going to have to do quantitative easing. What does all that mean? More free money. So more of this stimulus into the markets, into these companies, which would push stock prices higher. So that's what's happening or has been happening for the last couple of months, is traders are saying, recession, bring it on, because that means more free money to pump up the markets. However, on the flip side, that also means that the traders and people in the markets have been looking at inflation very differently, because typically high inflation reports would mean good news for stocks. Because if there's high inflation, that means that now companies are charging higher dollars. They're bringing in more revenue, even though they might not be selling as much stuff. But high inflation typically means people want to get out of the dollar and they want to own assets like stocks. But for the last month, 2 months, it's been the opposite. High inflation has been bad news because that means a stronger fight on inflation.
Right.
So you have all these traders saying, well, if the Fed is going to be fighting inflation, that means higher interest rates. That means quantitative tightening. That means markets will go down. And so you have all these like people in the markets that are looking at just the next 1 step, 2 steps saying, okay, if we see a recession, that means that the Fed is going to start cutting interest rates, and that's going to mean that the market's going to go up. But what about now if we take 1 step back and we look a little bit further? Because now you start to see a different picture. This is why traders and investors look at the market very differently, where traders are looking at the next 6 months, maybe 12 months, versus investors are looking at the next 10 years.
Right.
If a recession is very bad, well, that means now the Federal Reserve Bank is going to have to fight the recession. Now, if they're fighting a recession, that means they're going to be cutting interest rates. That means they're going to be stimulating more. All those contribute to higher inflation.
Mm-hmm.
Now, the next inflation report is probably going to be way better than the one that we saw a couple weeks ago where it was 9.1% inflation. We're probably going to see inflation cool down a little bit because energy prices have come down. We've been seeing some businesses do some liquidation events. However, that doesn't mean that inflation has gone away. We're not going to magically see inflation come back down to 2% just like that. But the Fed and the government might claim a win for inflation, just like how nowadays gas prices are like $4 a gallon.
I think I saw like 450 something.
Yeah, so something
that,
around $4. It's some people are saying it's a win. Gas prices are coming down. $4 a gallon for gas. I don't know if you want to consider that a win. I mean, it's better than where we were, but bad is still bad.
I
right?
mean, compared to 2 years ago.
Yeah, I mean, it's all relative. But this is where now we might come down to 7%, 6%, 5% inflation, and we might claim that we won the inflation fight and then start stimulating again. And then what? Well, then the inflation will start to pick back up. And now you start to see the little puzzle pieces, because now if inflation continues to get worse, now the countries around the world that are looking at the dollar as a safe haven may say, well, we don't like that we're losing 5 to 7% of the value of our savings every single year, because you have countries like China, Japan, I mean, all these big countries around the world, they're saving dollars because the dollar is the world's reserve currency. People want the dollar. I was in Canada the last weekend, and it was funny that I gave someone some money, and they were so excited because I gave them USD. I gave them a United States dollar as opposed to Canadian money, because apparently, from what it seems, people in Canada would rather have United States dollars. Why? Because United States dollars are worth more than Canadian dollars. $100 from Canada is not worth as much as $100 from the United States. And it's just one of those things where people around the world want the dollar. But what happens now if that sentiment starts to change? Now that plays a big impact into now the health of our currency. That plays a big impact into the health of our companies, because they're all operating in dollars and they rely on the strength of the dollar. Now you can start to see where we're not looking at the next 6 months. We're starting to look at the next 10 years. What's going to happen? And this is the things that you want to start thinking about, where how is inflation really going to affect the health of our economy? How is it going to affect the health of our markets? And this is where the Fed, I've been talking about this for a while now, but the Fed is really going to have to pick their poison. Do you want to fight a recession right now? Or do you want to fight inflation? Because fighting inflation is going to be painful right now. Raising interest rates right now is going to be painful. Doing quantitative tightening is going to be painful. We're already seeing it in the economy. We're seeing the economic slowdown. So all these things hurt the economy. But what about then is the Fed going to do next? Because now if the economy starts to hurt, are they going to then give up the fight on inflation and say, all right, inflation is better. We brought inflation down from 9% down to 5%. Now we can focus on the economy. Inflation is going to keep going down. Let's start stimulating. And then they start stimulating, and now you start pumping more money into the markets, but then inflation is going to slowly start creeping back up again. And this is where, right, you start to see this teeter-totter where you got to really pick one. You can't just keep flip-flopping between one and the other. And this is the worry, and this is what traders are already pricing into the markets. They're already saying, we want the recession because that means that the Fed is going to stimulate. That means that the Fed is going to pump up the markets. And this is where you got to understand the dichotomy between recession versus inflation. They're two different things. And the fight is going to be led by the Federal Reserve Bank, and that's
Right.
going to determine what happens. So we talk about how long is it going to last. Depends on what the Federal Reserve Bank does.
And I want to ask, how is this going to all affect the global economy?
Well, the whole global economy is slowing down right now. Europe is really getting hit hard. They're on the brink of recession, if they're not already in recessions over there. The Canadian economy is getting hit hard. We have a lot of the smaller countries that are getting hit hard. We talked about Sri Lanka, how they have already defaulted on their national debt and how it put their whole country into chaos, complete just collapse. The prime minister and president had to literally flee the country.
Yeah.
It was crazy over there. They're saying that Pakistan, or Pakistan, as some people like to say it, are also potentially in the danger zone of defaulting on their national debt. There's, I think, about another dozen countries or so, which are kind of in that red zone, on the real, like, oh man, they're in the real struggle area. And I read an article over the weekend that said Canada's real estate market is now being predicted to go down further than what happened during the 2008 crash. So I think, if I get the numbers correct, it was like a 33% drop in the real estate values during the 2008 crash. And they're expecting that between now and the next couple of years, that the Canadian real estate market will drop in value by even more than that, by 35 to 37% is what they're predicting over the next couple of years.
Wow.
So all of these things affect the United States, even though it might not directly affect us, because countries buy things from the United States. We do buy things from other countries, but countries do buy things from us as well. And so, we live in a global economy where when one country, especially if it's a big country, if it's, something like Germany, something like Canada, if one of these countries are getting hurt, that can also hurt the United States, because these are big purchasers of things from the United States. And we also purchase a lot from these countries. So this is where, we are really just watching in real time a potential financial crisis. And if it's not a financial crisis, it's the building up of a financial crisis. Because the reality is, this inflation problem is not going away. We have a lot of money in the market that needs to be taken out. However, if we want to avoid the pain right now and we just start stimulating in the end of 2022, or we start stimulating in the early part of 2023, even though our inflation fight hasn't gone away, we're building up the bubble even bigger. So we're watching all this happen right now, and most people don't even see it happen. If you turn on most of the traditional financial news, if you turn on CNBC, what are they saying? Well, you have they always bring on the different opinions. Some people say the world is ending. Some people say nothing's wrong in the world. But this is where, you got to be able to do your own financial education. You got to be able to do your own research. That's why, one thing on the news, I said the number one best way to get financial news is directly from the source. Read the press releases, read the actual data, read the actual reports that come out, the actual data, and analyze it for yourself. If you can't do that, then join something like Market Briefs, which is the free financial newsletter that I created, where every day our team breaks down exactly what's happening in an unbiased way, from the stock market to the real estate market to crypto to inflation to the global economy. It's completely free. If you haven't joined Market Briefs, I'll put the link for you down in the description. But the whole reason and idea behind this is you got to understand what's happening, because it's happening right in front of us, and it is going to affect everyone around the world. And this is not something that's like a 6-month thing or even a 12-month thing. We're looking at it's really a number of years. And depending on what the Federal Reserve Bank does, we're talking about a potential decade of uncertainty. Because if we start stimulating, we start cutting interest rates, you're going to see home prices start shooting up higher. You're going to see stock prices shoot up higher. You're going to see the price of things start growing even quicker. And now it's just building a bigger bubble. And you're going to see a bigger divide between the haves and the have-nots, and it's going to be a real shift in the economy and the way that the economy has been done. It's going to be very different then than when it was 5 years ago. If we go through the recession, the question is, how bad is it going to be? And we don't know. And you know, there's nobody that can predict how bad or how severe it's going to be. But this is where you really just need to let the bad assets fail. And it hurts because that means people lose their jobs. It means people lose investments. But the alternative of facing a potential currency crisis is even more painful. And this is where now the Federal Reserve Bank has to make a decision. And this is where you want to pay attention to what's happening, but also be making sure that you're investing your money in the right places. Because now, you know, I'm not a speculator. I don't know what's going to happen, which is why I invest my money the way that I do. I've talked about this. I invest my money in 5 places: my business, market briefs, and the startups that I invest in. I invest in physical real estate, something that I can see, feel, and touch to generate cash flow and tax benefits. I invest in stocks. I invest in cryptocurrency, and I invest in physical gold. I don't know which one's always going to be the best, right? Gold is my inflationary hedge, and it's my insurance in case everything else goes wrong. It's a small piece of my portfolio, but in case everything else goes wrong. Cryptocurrency is my more speculative, more fun, high-risk investment. I'm investing in Bitcoin and Ethereum and a couple of the coins every day. So I don't really care what happens in the markets, whether it goes up or down. In the stock market, there's 2 different ways that I have invested in the past. It is a passive strategy and an active strategy. Now, passive strategy is now every week, every Wednesday, and it doesn't matter the day, just for me it's Wednesday, I have money leaving my account that's automatically invested into a number of different ETFs. And this happens whether the market is up or down, and it does not matter because I just want exposure to the markets and I just want to own a bigger piece of, you know, equity of the companies. So I have ETFs that give me exposure to the S&P 500. These are value companies. These are companies that I believe in for the long term. But I'm not investing in the individual companies here. I'm investing in the ETFs. I have ETFs that give me exposure to innovation and technology. Highly speculative. They get hurt the most when you raise interest rates, but they also benefit the most in a bubble economy, right? So it's getting different types of exposure there. I'm investing my money in emerging markets, which are companies and countries overseas that are growing. And now this gives me diversification against the dollar and companies outside of the United States. Again, now this is more risky because these are countries that are not as stable, but more growth potential because now as the country grows, the companies can also grow significantly faster. I invest some of my money into dividend-paying companies, or ETFs rather. Again, just another alternative to the value investing S&P 500. So those ETFs are completely passive, and it happens automatically and consistently. Remember, I talked about this, I think, last week, where I use M1 Finance. They are an affiliate from Minority Mindset. It is very simple to use. So if you want to see them, use my affiliate link. The link is in the description. Then on the active side, that's where now I would invest in individual companies. Now, I haven't been doing this as much recently. I've talked about this in a video. But the reason why isn't because of the market. The reason is because I'm investing more money into market briefs because I want to build and grow that company. But active investing means that now you're investing in individual companies and you're spending the time and effort to research these companies when times are good. That way, then when a good buying point arises, meaning a lower price, you can come in and buy. And this can be extremely lucrative, but it takes more time, more risk than an ETF because now you got to actually find the company, listen to the earnings calls. You got to pay attention to what's going on with their revenue, their profits, see their executive structure, see what they're doing, how they're innovating. And this is where now it can create more opportunity again, but you have to be willing to put in the time and research because what happens to so many people is you get sucked into investing for the attractiveness of investing. Oh, I'm investing in these hot companies, and you go and start chatting about it. You start reading forums about investing and trading, and it's very attractive, and you can see people make a ton of money overnight. But the real wealth is that silent wealth. It's the unattractive thing where you're just buying the right companies when they're cheap, and you're going to hold on to them for the long term. That's where the real wealth is built. Real wealth is built in silence versus that short-term wealth is loud. It's flashy. And so now if you want to build that real wealth, it's finding those strong companies that you can buy at a discounted price. That way then you can come in, purchase it, and just kind of ride the wave up. But again, it's risky because when things go down, some will go to zero. And now this is where the right financial education is important. That way you can find the right companies. Now, of course, investing is risky. You're never guaranteed to make money when you invest. You have to do your own due diligence. But the best time to find good deals is when you're in a market crash, is when you are in a recession, because now you can buy investments on sale at a discounted price. And that's why recessions make more millionaires than any other time. It's because now you can come in and buy the deals at a discount.
You mentioned before that a recession is a good thing. Should people be worried?
Well, it's a good thing for people who understand financial education. It's a good thing for people who understand how to use their money. It's a good thing for people who know how to find the right opportunities. But for the majority of people, it's not a good thing because now it creates anxiety, it creates fear. You're worried about your job being lost. You're worried about everything that's wrong with a recession. That's why I'm called the minority mindset. It's all about thinking differently than the majority of people. So now it's understanding the difference between how a recession affects the majority of people versus how you can find the opportunity in a recession. That's what I'm talking about. It's good because now you can find opportunity. Now, your question was what was your question?
Should people be worried?
Should people be worried? Well, you should be worried if you have no savings, if you have no cash to invest, if you have no backup plan, if you have no idea of how to capitalize on a recession. But, this is where the right education is so important. And so now if you break this down to the different steps, first is your income. If your job is unstable, you're working at a startup that is struggling, then you want to think about how you can find a new secure income stream sooner rather than later. Maybe you want to consider getting a new certificate. You want to make sure you have some sort of valuable skill where you can get an income to keep funding your family, to keep taking care of your lifestyle, and have cash to invest. Second, this is where now you want to make sure that your finances are okay. So if you have credit card debt, pay that off as fast as you can. And it's hard now because interest rates are going up, but that's even more reason why you need to pay it off sooner rather than later, because your credit card debt is variable interest rates, meaning the payments that you make are not fixed. It's going to change based off of what interest rates are. And as we're in this rate heightening cycle, well, that means that interest rates on your credit card are going to go up, which means your payments are going to go up, even if you don't have a bigger balance. So you want to pay that off. And that also means you want to put aside cash to invest. Now, we've been talking about how inflation eats away at the value of your savings, but right now in this economic environment, having cash can be very valuable because now it gives you a tool to go out and invest in companies and investments, real estate, whatever it might be, to invest in assets at a discounted price. So you want to be putting aside cash right now for your investments. Get aggressive. And that might mean you have to downsize on your lifestyle. It might mean you need to earn more money, but you want to create this margin. That way you can purchase the opportunities that may come your way. And that also means potentially having a passive investment strategy set up. You could passively invest in real estate. There are crowdfunding sites now that will allow you to passively invest your money every month and get exposure to real estate. You can passively invest in stocks. You can passively invest in crypto. You can passively purchase physical gold. Technology has made investing so much simpler. And you need to capitalize on it because these are the things where now, before, were only reserved for the super wealthy, people who had access to this and people who were knowledgeable. But nowadays, like, if you have $10, you can start investing your money.
True.
There's no excuse not to. If you don't have $10, you got $1, and there are apps that let you start investing with $1, right? And so there's no excuse not to be doing anything anymore. And this is where now it's the education now is the important part, because now once you can get financially educated, now you can start doing the right things to help take care of yourself, to help take care of your finances, to help take care of your family. And this is where now it's just finding the right opportunities. And now maybe it's in crypto, maybe it's in stocks, maybe it's in real estate. You know what the assets are. Now this is where you got to do that kind of deep digging for yourself to know what it is that you believe in. Research crypto if you like it. Research stocks if you want to. Research real estate if you are interested in that. Research investing in startups. It doesn't matter what it is that you want to invest in. The key is you want to be investing in something that you're buying for the purpose of making money, that you can buy at a discounted price, but it requires you to do that education and have the cash. And when it means to have the cash, that means getting prepared when times are okay. And you might think, but Jaspreet, inflation is so high, the economy is slowing down, how are times okay? Well, it's still relatively okay because a lot of people still have jobs and it could be much worse. So use now as an opportunity to build that buffer to take care of yourself. That way you can capitalize on downturns or whatever might be coming, right? Because we don't really know what the Fed is going to do. We don't really know what's going to happen in terms of like government intervention. So we don't know what's going to happen with that, but there will be opportunity. That's a guarantee. There will be a massive amount of opportunity. And 10 years from now, we're going to look back and you're going to see a whole new wave of millionaires born because of what happened over the next 2 to 4 years. And this is where now you want to be one of those people. But in order for you to be one of those people, you have to be prepared and you need the right financial education.
Yeah, there's definitely opportunity out there. I saw a stat the other day. I think at the beginning of 2020, we had around $3 trillion in circulation, and now there's around $20 trillion.
Yeah.
So I want to ask you, too, going off of that, how has that kind of played a role in the Federal Reserve fighting inflation? And how is that going to play a role in them kind of stimulating the economy versus fighting inflation?
So the interesting thing about that, I think you're talking about M1, which is the monetary supply. And what's interesting is what you'll see. If you go to Google right now and you search Federal Reserve Bank M1, what you'll see is this chart of the monetary supply. And M1 is literally just defined as the amount of dollars in circulation. And the interesting thing about that is if you go look at it, you'll see this kind of just calm line, and then you see March or April of 2020, and then it just boom shoots up to like I don't know 18 trillion or something. I mean it's just crazy exponential increase, and then it goes up to above 20 trillion. And what that means and what that tells us is there's a lot more dollars in circulation. But the interesting thing, because there's a little hidden data behind that, there's also the definition of M1 changed in April of 2020. And that's where the Federal Reserve Bank justifies the reason why you see this huge spike in M1 is because the definition of M1 changed, where they expanded the definition of money. Now, when I hear that, it keeps me scratching my head because like, okay, you just changed the definition, which is fine, but why in April or May of 2020 when the pandemic hit and the money printer opened? And now, I can't justify this. I don't have an answer for this, but my theory would be that it's a way for them to kind of mask how much money was truly printed and created in 2020 and 2021. Because if people really knew, if we had a real number as to how much money the Federal Reserve Bank printed and gave to the government, corporations, people, into markets, into buying and bailing out everything, I think you would see a lot more unrest, and I think you would see a lot more people being angry, because that you can really then define how much inflation happened, how much did we inflate the monetary supply, but we don't have that because they happened to change the definition of money then. So, what does it mean? Well, what we know is that there was an insane amount of money printed, and this money was injected into the economy, and there's a lot more dollars out there, and now they're working to take the dollars out. And so what does that mean? It means that, you don't have to create the money. You just have to find a way to put that money in your pocket. And either you're going to earn it through your labor, or you can earn it through your capital. So what does that mean? You can either earn it from your job, you go to your work and get a paycheck, or you can earn it through your investments. Because I say that everybody in America should be a business owner, but the majority of people should not be in the business of trying to operate a company, and the majority of people should not be in the business of trying to start a company. So what does that mean? Well, now you go to work to earn money from your labor, and then you take the money from your labor and you invest a piece of it into assets, into things like stocks, real estate, startups, maybe cryptocurrency if that's what you believe in. But the key here is understanding what's going on, because there's more money than ever out there, and all you want is a piece of the money in your pocket, in your investment portfolio. And the way that you do that is to own the investments.
Right. Absolutely.
Well, good one. Good questions today, Nate. Then that was an interesting stat that you brought up in the end.
Yeah.
If you want to see more of Nate, check out Nate on his channel, Nate Gregory, where he talks about financial news. Thank you for watching. This is Guaki as always. And as always, keep hustling. So now we have the highest home prices ever. We saw more than a 20% growth in home prices in the last year. We saw more than a 20% growth in rental prices in the last year. And now mortgage rates are skyrocketing. Mortgage rates have doubled since the beginning of 2022. So within 1 year, like in 6 months of 1 year, mortgage rates literally doubled.